There are people watching this right now who made a transaction last month, a transfer, a deposit, a withdrawal, and have no idea that the IRS already knows about it. Not because they did anything wrong, not because they are under investigation, but because a rule that most Americans believe works one way was quietly changed, and the new version works in a way that most people have never been told about. My name is James Carter, and I am a licensed tax professional with USA Law Signal. I have spent the last 15 years helping Americans navigate the IRS, not reading about it, not theorizing about it, sitting across the table from it on behalf of real people. And I will tell you the single most consistent thing I see in my work. It is not people who cheat. It is people who followed the rules they thought they understood and then discovered the rules had changed without anyone telling them. That is exactly what is happening right now with the $10,000 bank rule. And before I go one sentence further, I need to clear up the single biggest misunderstanding about this, because it is the reason most people either panic unnecessarily or dismiss this entirely and leave themselves exposed. This is not only a problem for wealthy people with large accounts, and it is not only a problem for people who deal in cash. Whether you are a retiree living on Social Security, a small business owner depositing weekly sales, a senior who just sold a property, or someone who received an inheritance, the changed rule touches your situation. I am going to tell you on every single point exactly who it affects and how, so nobody watching can say this does not apply to me. Before I get into the specifics, if you are not subscribed to USA Law Signal, please do that right now and turn on the bell notification. Here is why it genuinely matters. Tax law changes constantly. IRS reporting thresholds, bank reporting requirements, penalty structures, and compliance deadlines shift every single year. And when they change, the IRS does not send you a personal letter explaining what changed and what it means for your account. They update the rule and expect you to already know. What we do at USA Law Signal is take those changes, break them down in plain English by what they actually mean for your specific situation, and get that information to you before the consequences arrive. The people subscribed here find out in time. The ones who are not tend to find out after the notice arrives, after the penalty is assessed, after the damage is already done. Hit subscribe, turn on the bell, and let me tell you exactly what changed. Let us start with what most people think the $10,000 rule is, because the misunderstanding itself is part of the problem. Most Americans believe the rule works like this. If you deposit or withdraw $10,000 or more in cash in a single transaction, your bank files a report with the federal government. That report is called a Currency Transaction Report, or CTR. The bank files it automatically. You do not have to do anything. And as long as you are not doing anything illegal, the thinking goes, it does not matter. That understanding is outdated, incomplete, and in the current environment, dangerous. Here is what most people do not know. The $10,000 threshold has never been just about single transactions. Alongside the CTR system, federal law has always required banks to file a second type of report called a Suspicious Activity Report, or SAR. And unlike the CTR, which is triggered by a single transaction over $10,000, the SAR can be triggered by any pattern of transactions that a bank believes is designed to avoid the $10,000 threshold, even if no single transaction comes close to it. This practice has a legal name. It is called structuring. And the IRS and FinCEN, the Financial Crimes Enforcement Network, treat structuring as a federal violation regardless of whether the underlying money is legal. You can have completely legitimate funds, pay all your taxes, and still face asset seizure and federal charges simply because your transaction pattern looked like an attempt to stay under the radar. Courts have repeatedly upheld this, and the enforcement has accelerated significantly. Now, here is the change that most people have not heard about, and this is the part the IRS is hoping you will not notice. The IRS has expanded its data sharing and analytical framework with FinCEN in a way that dramatically increases the number of Americans whose banking activity is being reviewed. For decades, the $10,000 CTR system operated as a relatively blunt instrument. A transaction hit the threshold, a report was filed, it went into a database, and unless there was an active investigation, it rarely went further for ordinary Americans. That is no longer how the system works. Beginning with updated guidance issued in late 2025 and expanded in early 2026, the IRS now cross-references CTR data with tax returns, income records, Social Security benefit payments, and third-party payment platform reporting. What this means in practice is that a deposit flagged by a CTR no longer just sits in a database. It is automatically compared against your reported income. If there is a discrepancy, if the deposits in your bank account do not match the income on your tax return, that discrepancy is now flagged for follow-up without a human agent having to manually review your file. This is not a theory. This is the operational result of the IRS's expanded use of automated compliance tools, which the agency has publicly committed to scaling up through 2026 and beyond, using funding from recent federal legislation. The agency's own published materials describe this as moving from reactive enforcement to proactive identification of compliance gaps. For the average American who reports all their income correctly, this change may produce nothing more than an inquiry letter asking for documentation. For someone who received money that was not reported an informal payment, a cash gift above the annual exclusion, proceeds from a sale that was not properly disclosed, the automated cross-reference can initiate an audit without any human ever choosing to target you. The system finds you. Let me break down exactly who this affects and how, because this is where both groups, the lower-income senior and the financially comfortable retiree, need to pay close attention in different ways. For seniors and retirees on fixed income, the most common exposure point is this. You received money this year that you did not think of as reportable income. A large cash gift from an adult child, proceeds from selling personal property, jewelry, furniture, a car, collectibles, an informal payment for services, a transfer from a family member that hit your account as a lump sum. None of these feel like taxable events to most people. Some of them are not, but when they hit your bank account and trigger a CTR or a pattern that generates a SAR, and the IRS automated system compares that deposit against your reported income, the discrepancy creates a flag. And that flag can generate an inquiry that requires you to document the source of every dollar. The correct response is not panic. The correct response is documentation and understanding. If the money was a gift, the gift tax rules apply to the giver, not the receiver, and amounts under the annual exclusion, $18,000 per person in 2026, do not require reporting by the recipient. If it was proceeds from the sale of personal property at a loss, it is generally not taxable and not reportable as income. Knowing the rule and having documentation ready is the difference between a letter you can answer in 10 minutes and an audit that takes months. For financially comfortable retirees with larger accounts, investment income, or proceeds from property sales, the exposure is different and in some cases more significant. The most common scenario I see in this category is what I call the silent accumulation problem. Over a retirement that has gone reasonably well, a person accumulates money across multiple accounts, brokerage accounts, savings accounts, money market accounts, inherited accounts. They make periodic transfers between those accounts for legitimate reasons, rebalancing, consolidating, moving money for a home renovation, funding a large purchase. Each transfer moves money that has already been taxed. None of it feels reportable because it is not new income. But from the IRS automated systems perspective, a wire transfer of $50,000 from one account to another, combined with a series of smaller deposits and withdrawals in the weeks around it, can generate a pattern that triggers review. The burden is then on you to document that the money was already taxed, that the transfers were between your own accounts, and that no new reportable income was generated. Here is what to do. If you regularly move money between your own accounts in amounts that could trigger reporting, maintain a clear paper trail. Keep records of account ownership, keep records of transfers with dates and amounts, and keep records of the tax basis of any investments you move or sell. This documentation costs nothing to maintain and can save you months of correspondence with the IRS if your activity is ever flagged. The third area where this change is creating real problems, and this one cuts across both groups, is third-party payment platforms. Venmo, PayPal, Cash App, Zelle. The IRS reporting threshold for third-party payment platforms was lowered significantly in recent years. And the practical result is that payments received through these platforms that exceed $600 in a year now generate a 1099K that goes to the IRS. If you received money through any of these platforms and did not report it because you thought it was a personal reimbursement, because you did not know the threshold had changed, because the platform told you it was not reportable, the IRS may have a record of it that does not match your tax return. The fix here is straightforward but time sensitive. Review your accounts on every payment platform you used in 2025. Identify any payments that could be characterized as income. If you receive payments for goods sold, services performed, or any other business type activity, even informal, those should have been reported. If they were not, a voluntary amended return is almost always a better outcome than waiting for the IRS to find the discrepancy through its automated cross-referencing system. Now let me give you 3 specific actions to take before the end of this month. These are not theoretical suggestions. These are the exact steps I walk my own clients through when this topic comes up. Action number 1, pull your bank statements for the last 12 months and identify every transaction at or above $9,000. Not just $10,000, $9,000. Write down what each one was, where the money came from, and whether it was reported on your tax return if it was income. You do not need to send this to anyone. You need to have it ready in case a question ever comes. 1 hour of your time now versus months of documentation requests later. Action number 2. Log into every payment platform account you have, Venmo, PayPal, Cash App, Zelle, any other, and check your transaction history for 2025. Look for any payments received that could be characterized as payment for goods or services rather than personal reimbursement. If you find anything that was not reported and should have been, contact a tax professional about filing an amended return before the IRS automated system flags the discrepancy. Action number 3. If you made any large transfers between your own accounts in 2025, moving money between banks, consolidating accounts, wiring funds for a major purchase, document the paper trail. Now, while it is easy to reconstruct, write down the account numbers on both ends, the date, the amount, and the reason. Keep that documentation with your tax records for the year. None of these actions are admissions of wrongdoing. All of them are what a careful, informed person does when the rules change in a way that affects how their ordinary financial activity is reviewed. Let me tie this together before you go. The $10,000 bank rule has not been repealed. It has been expanded and integrated into a broader, automated compliance system that cross-references your banking activity against your reported income in real time. The threshold that triggers a currency transaction report is still $10,000. But the system looking at what that report means for your tax compliance is significantly more sophisticated than it was 2 years ago. The people most at risk are not criminals. They are ordinary Americans, seniors who received a lump sum they did not think to report, retirees who moved money between accounts without documentation, people who used payment apps without realizing the income reporting threshold had changed, who are now exposed to automated inquiries they never anticipated. The fix is not complicated. Documentation, awareness, and where necessary, an amended return filed before the system finds the gap rather than after. If this video helped you, share it with someone you know who manages their own finances and may not have heard about this change. A parent, a neighbor, a sibling approaching retirement. One conversation today can prevent a very stressful letter 6 months from now. And if you have a specific situation you are not sure about, a large transfer, an unreported payment, a deposit you are not sure how to categorize, the link in the description below connects you to a consultation with our team at USA Law Signal. We look at the actual numbers, we tell you exactly where you stand, and we tell you exactly what, if anything, needs to be done. Subscribe to USA Law Signal, turn on the bell, and I will see you in the next one.